These are, from what I can tell, the best quarterly results in the 36-year history of the company.
Yes, Andrew, great to see you. It's great to be here. We had an extraordinary quarter. We had record results really across the board, either the best or near the best in appreciation in our funds, which is so important, in fundraising, in earnings. It was really remarkable. And I would say it's a result of two things. First, we've really been focused on some thematic areas, and we benefited from that. Global logistics did quite well, software, technology, those areas really supported us. Also, the recovery in travel helped us as well. And then the second thing, which we talked about last quarter, is the expansion in our business of who we serve and where we invest. So if you look at our Core Plus real estate business, our infrastructure business, our direct lending, they're growing rapidly. And we're also serving more institutional customers, more retail customers, more insurance customers. Those two last categories represent more than a third of our business today. And we mentioned before that we see our business as really moving from a narrow channel to much more open waters, and that feels like it's accelerating these days.
Hey, John, help us with this, given that you have your pulse on so many different industries and businesses around the world. We keep talking about the issue of inflation and what it means in the supply chain issues when it comes to labor. What are you seeing in your businesses?
Well, like a lot of your guests, we're seeing inflation in a lot of different places, and increasingly feels more pervasive and persistent than I think many people hope for. You know, some areas are transitory, I'm guessing at the ports and semiconductors. But when you look broadly, I think a lot of this will stay longer. And the reason I say that is, first, the money supply out there has grown by more than a third since COVID began. A natural response governments did to support the economies, but there's a lot more money in circulation. And then you add to that, we have a number of areas where there are structural shortages. So if you look in housing, for instance, we're building 40% fewer homes over the last decade than we did prior to the financial crisis. In energy, we've been investing globally less than half of what we did 7 years ago. Now, a lot of that's positive for the environment, but it creates near-term shortages. And then in the labor markets, despite more than 10 million job openings, we have 3 million fewer people in the workforce. Some of that's obviously pandemic-related, retirement-related. And so you've got a lot of these structural shortages, a lot of capital chasing things, and that's driving up prices. And if you want to be a little bit concerned about CPI, in this last quarterly report at 5.4%, housing costs were up just 3% in the data. It's the largest component of core CPI. And on the ground, as we know, new homes, rental home prices are going up much more than that. So we've got real concerns around inflation.
So John, though, speak to that. We talked to Paul Tudor Jones yesterday, who effectively said Jay Powell is the wrong man for the job. He thinks, obviously, rates are too low. But you're in an interesting place because you rely oftentimes on very low interest rates to finance the transactions and acquisitions that you make. And at the same time, you're seeing the effects of that on the other end.
So I'd say on this, I think the inflation numbers will lead the Fed likely to taper a little bit faster, to raise rates. My guess would be a little bit earlier. And as it relates to our business, the good news is we've been thinking about inflation for quite some time. And so if you look at our credit portfolio, almost everything we do is floating rate. And if you look across real estate and our private equity portfolio, we've really oriented towards faster growing businesses. If you think about the value of any asset, it's a function of the multiple you pay for it and the earnings. Rising inflation, rising rates hurts multiples. So the way to offset that is buying faster growing companies and some of those thematic areas around the migration of everything online, sustainability, life sciences. A bunch of the areas we've focused on, we think are better positioned in a higher inflation environment. But yes, I think it's a risk for all investors.
Hey, John, that's a pretty politic way of answering Andrew's question. The higher inflation that obviously you all think is here to stay, if that's the way you're positioning your portfolio and getting ready for it, Do you think that it's potentially very dangerous, as Paul Tudor Jones kind of laid out to us yesterday? He thinks it's the biggest threat facing society right now. Do you think that he's on target with that, or is he maybe more concerned than you are?
Well, I would say it's certainly the biggest risk from an investment portfolio standpoint. And yes, there are concerns about lower income consumers because so much of what they consume is exposed to inflation. And I think policymakers in Washington get this. You know, I feel fortunate I'm in my job, not theirs. They're trying to balance this against a global pandemic and trying to thread the needle. So my guess is, as I noted, I think they'll be forced to move a little faster. That'll help stem this. Some of this is transitory, but I do think we will end up with higher levels of inflation, and there is some risk around that. It is the biggest risk out there. I would agree with that.
Shepard Smith here. Thanks for watching CNBC on YouTube.